Jim Caron, there's a quote from you that I wanted to share with our audience. You said the following, and here it is. Global central banks may merge their policy reaction function to the balance of risks, a policy that balances growth and inflation risks. You've gone on to say, to justify why they may be unwilling to adapt policy to push inflation down to target and keep it there. Jim, I have to say, are you making the case to be bullish risk based on that?
Well, John, I've been making the case to be at least a little bit more balanced in terms of risk, and I've always said that risk on is a risk, and it needs to be hedged like any other risk since the beginning of the year. But the point of that statement was that yes, central banks want to get inflation down, but it seems like they're failing to get it down to target, and they're unwilling to get it down to, say, a 2% level of target. In which case, they're probably not going to hike aggressively enough or keep rates aggressively high enough for long enough to really get inflation down to 2% and keep it anchored at 2%. So while I agree that inflation is coming down, there's no question about that. It's just a question of saying that 2% is no longer the ceiling for inflation. It's the floor. I still think it's going to stay in that 2 to 3% range. It could be a little bit higher, which means that their policy, by definition, relative to their own inflation target, is going to run a little bit easier. And that is going to be supportive for riskier assets. So one of the things that we've done in portfolios and investing is we've tried to stay a little bit away from very interest rate sensitive parts of fixed income. So more leaning towards credit, towards high yield and things like that. And also to the broader equity market is something else that we think that is a good balance to also having some high quality fixed income.
We're thinking about 4,400 now on the S&P 500. You've seen a whole host of characters on Wall Street change their year-end price targets over the last several weeks, starting to capitulate from this view at the start of the year that we'd see 4,000 to a view that maybe we'll see much more than that. Bank of America, new year-end price target, 4,300 was 4K. Evercore, 4,450 was 4,150. Goldman in the last couple of days, 4,500 was 4,000. Jim, making the case to be long equities. That's what you're doing right now. Can you tell me what you're advocating for in fixed income? In treasuries, if you believe this is a Fed that could tolerate stickier inflation and try and support growth, is that high yield to the long end?
Well, the thing is that as long as inflation remains contained or at least still coming down, and there is an expectation that there is going to be a slowdown and possibly even a recession at some point, that's a very, very fat tail risk. So therefore, bond yields have to stay likely lower than even the Fed funds rate for an extended period of time. So that in and of itself eases financial conditions because it just puts more emphasis on riskier assets like equities and even high yield credit and things like that. So I'm not suggesting that we're in a big bear market for bonds. I think bonds are going to do okay, but that's the point. They're just going to do okay. This was supposed to be so far the year for fixed income. Right now, fixed income returns are up about 2%, and equities are up around over 10.